If you have ever tried scalping fast-moving markets, you already know how aggressive and unforgiving they can be. One wrong entry, and you are out instantly. Yet some traders scalp these exact moves every day and stay consistent, not because they know more setups than you, because they run one engine. Hello traders, welcome back to Lucro. In today's video, I'm going to show you the scalping strategies professional traders use on the 1-minute and 5-minute charts. The exact setups I would rely on if I had to trade this kind of market every day. Each one follows clear mechanical rules, and I'll break them down step by step. But watch for something as we go. All three setups share the same core. One engine, 3 different fuels. By the end of this video, you won't just have a complete roadmap to approach scalping with more clarity, you'll understand the machine itself. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we dive into the strategies, one thing needs to be clear, because this engine doesn't run on every market. Some markets are better suited to liquidity sweep-based strategies, while others tend to react more clearly to higher time frame levels, supply and demand zones, order blocks, and fair value gaps. Gold is a strong example of exactly this kind of behavior, because it often travels from one key area to another with very clear structure. And that points to the engine's one non-negotiable rule. A powerful scalping strategy is built only on setups that follow higher time frame delivery as the main source of confirmation. The higher time frame tells you where, the lower time frame tells you when. With that in mind, let's load the first fuel. Fuel number 1. The liquidity sweep and the order block, trading the footprint that smart money leaves behind. To apply this correctly, you work with 2 time frames. Start with the higher time frame to analyze the overall market condition. This is where you mark manually on the chart the liquidity sweep, the break of structure, and the order block connected to that move. Then you zoom into the lower time frame to follow the higher time frame delivery and watch for reversal or confirmation signals. That's where you wait for your entry model to appear before opening any position. Now let's go step by step and see exactly how this setup plays out. To begin, you need to identify a key liquidity sweep, or liquidity grab, together with a break of structure on the higher time frame. Everything here is marked manually on the chart, because the focus of this video is understanding the logic clearly and recognizing each part of the setup on your own. In this bullish example on the higher time frame, the first thing you want to find is a bullish liquidity sweep. In simple terms, you want to see price take out a key level, reverse immediately, and then confirm that reversal with a break of structure. From there, mark the setup manually. In a bullish case, that means spotting the moment price sweeps below a recent key swing low, shows a strong rejection to the upside, and then delivers a bullish break of structure. And pause on that candle, because there's a story inside it. When price breaks a low, the crowd feels the breakdown and sells. Loss aversion pulls the trigger. The sweep is their stops becoming the liquidity that fills institutional buying. You're learning to read the trap, not fall into it. After that, the next step is to mark the order block that initiated both the liquidity grab and the break of structure. That area becomes your higher time frame point of interest. More often than not, price revisits this block, where it behaves like a demand zone, and smart money steps back into the market. For those who may still be wondering, an order block is a decisional zone where large volumes are positioned right before a major expansion. Because of that, price often reacts or reverses when it returns to these areas. In a bearish scenario, a bearish order block is the last up-close candle, or series of up-close candles, formed right before a strong bearish move that causes a break of structure. By contrast, in a bullish scenario, a bullish order block is the last down-close candle, or series of down-close candles, formed just before a strong bullish move that leads to a break of structure. Once the order block is marked, the next step is simply patience. Wait for price to return to that zone. That's where your potential trading opportunity begins to form. Once price reaches the order block, zoom into the lower time frame and closely watch the price action for signs of a reversal. Those signs could include a market structure shift, a change of character, or other reversal patterns, such as an inverse fair value gap or an R pattern. After that, what we want to find is a violated fair value gap that transforms into an inverse fair value gap. That becomes our first confirmation. Once the inverse fair value gap forms, it often starts acting as a new support level, giving us a strong area for a potential buy entry. If a market structure shift appears at the same time, that adds another powerful layer of confluence and makes the setup even stronger. With both confirmations in place, we can expect price to retrace back into the inverse fair value gap, now acting as support, before continuing higher toward the next pool of buy-side liquidity, where we can plan the entry. With this model, you have two entry options. The first option is to enter immediately after the inverse fair value gap forms. In that case, you open the position at the opening of the next candle, with the stop loss placed below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed inverse fair value gap, and wait for price to retrace back into the zone and trigger your position before moving toward your take profit. For the target, you can aim for the nearest buy-side liquidity on the current time frame, or if you are looking for a larger move, you can target a key level on the higher time frame. The second entry approach is slightly more conservative, and that's exactly why it often gives you a better risk-to-reward ratio. And in cases where price has already started moving in my expected direction, my first position is running in profit, and there's still enough room for price to keep moving higher, I often look for a chance to add another position as a continuation setup. That usually happens when price forms a new bullish fair value gap during the next bullish leg that follows a new break of structure. In that situation, the next unmitigated bullish fair value gap becomes our second entry point. From there, we place a buy limit order at the highest point of that fair value gap, with the stop loss placed a few pips below the most recent swing low. Naturally, the exact opposite logic applies in a bearish scenario. And when trading gold, the time frames matter. The most effective higher time frames for identifying this setup are the 30-minute and 15-minute charts. Once a potential setup is identified there, you drop down to the 5-minute or even the 1-minute chart to execute the entry. Same engine, new fuel. In the first strategy, your point of interest was born from a sweep. Fuel number 2 goes straight to the source, the demand zone, the origin of the move itself. This setup also works with two time frames, the 1-hour and the 5-minute charts. On the higher time frame, we analyze the overall market condition, looking for unmitigated, high-quality supply and demand zones. From there, we zoom into the lower time frame to follow the higher time frame delivery and look for reversal or confirmation signals. As always, your entry model needs to appear before you open a position. Let's walk through it step by step on the chart, in a bullish scenario. To begin, confirm that price is in an uptrend and that buyers are in control of the market. To do that, you need to identify at least 2 consecutive bullish breaks of structure. Start by marking the structure manually on the chart. Once price forms 2 consecutive bullish breaks of structure, shift your focus to the most recent one and trace back to the origin of the bullish expansion move, the move that caused the break. That origin point is what defines the demand zone. The next step is to mark the most recent unmitigated demand zone on the higher time frame. After that, the job is to wait for price to return to that area. Once price taps back into the zone, move down to the 5-minute chart and closely observe the price action for signs of a reversal. This acts as your first confirmation, before you even begin looking for an entry, and it can come in the form of a market structure shift or a clear change of character. Notice what this setup demands of you. Nothing. The zone is marked, and price either comes back or it doesn't. That stillness is the hard part. FOMO keeps whispering that the move will leave without you. The professional answer? If it leaves, it was never your trade. What the market structure shift tells you is that the temporary bearish move is likely coming to an end, and bullish momentum may be returning. At this point, price is expected to align again with the higher time frame trend. Once that bullish structure is confirmed, and we expect price to continue higher, the next step is to look for a buying opportunity. At this stage, you need an entry model to form. For the first entry, I usually look for a bullish breaker block forming inside the higher time frame supply or demand zone. For a valid bullish breaker block, price should first form a swing low, then a swing high, followed by a lower low. After that, you want to see a strong expansion move to the upside that breaks structure and confirms the shift. In that sequence, the up-close candle, or group of up-close candles, formed between the first swing low and the swing high becomes your breaker block zone. That is the area where you plan your long entry. Everything here should be marked manually on the chart, step by step, exactly as shown earlier. From there, the next step is to place a buy limit order at the highest point of that breaker block and wait for price to retrace back into the zone. For your take profit, you can target the nearest liquidity on the current time frame, or aim for a key level on the higher time frame if you are expecting a larger move. And just like before, when price has respected the demand zone, your first position is already in profit, and a new break of structure forms, you can look for a continuation entry. This typically happens when price creates a new bullish fair value gap during the expansion leg of the new break of structure. In that case, the next unmitigated bullish fair value gap becomes your second entry zone. From there, place a buy limit order at the highest point of that fair value gap, with the stop loss positioned a few pips below the most recent swing low. On the bearish side, the same logic applies, just in the opposite direction. 2 fuels down, and the engine hasn't changed once. Fuel number 3 is the boldest, because this time you're not joining a trend, you're catching the moment it turns, the change of character. Just like the previous setups, this one also requires working with 2 timeframes. Begin with a higher timeframe, such as the 4-hour or 1-hour chart, to analyze the market structure and identify a clear higher timeframe change of character, together with an unmitigated fair value gap connected to it. After that, move down to a lower timeframe, such as the 15-minute or 5-minute chart, depending on your preference, to look for reversal signals, confirmation, and eventually a proper entry model. Step 1 is always the same. Analyze the higher timeframe structure and determine whether price is in a strong uptrend or a strong downtrend. In a bullish scenario, start by identifying a strong downtrend. To confirm that downtrend, price should form at least 3 consecutive bearish breaks of structure. On the other hand, to confirm a strong uptrend, price needs to form 3 consecutive bullish breaks of structure. Once that is clearly marked manually on the chart, the next step is to look for a higher timeframe change of character. When price breaks and closes above the most recent break of structure high of a strong downtrend, that signals a bullish change of character. This suggests that sellers are losing control and that the market may be preparing to shift direction. Once this shift in structure is confirmed and we expect price to move higher, the next step is to look for a buying opportunity. And understand why this entry pays. After 3 breaks of structure in a row, recency bias has convinced the crowd that the downtrend is permanent, so sellers keep pressing, late, into a market that has already changed its mind. The change of character is you reading the turn while they're still trading the memory. At this stage, focus on identifying a bullish fair value gap that forms within the change of character leg. After marking the higher timeframe change of character and its fair value gap manually on the chart, move down to the lower timeframe and wait for price to return to that higher timeframe fair value gap. Once price enters the zone, closely observe the price action inside the gap and look for signs of rejection. That reaction confirms that price is respecting the higher timeframe imbalance and gives you your first layer of confirmation. From there, the next step is to identify a violated fair value gap that turns into an inverse fair value gap, either inside the higher timeframe fair value gap or just outside it, after the rejection. This becomes your second layer of confirmation. When this inverse fair value gap forms, it often acts as a new support level, and this is where you begin planning your long position. At this point, the focus shifts to execution, and by now you know the drill. 2 options. The first is to enter immediately after the inverse fair value gap forms inside the higher timeframe fair value gap. In that case, you open the position at the opening of the next candle, with your stop loss placed below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed inverse fair value gap, and wait for price to retrace into the zone and trigger your position. For your target, you can aim for the nearest buy-side liquidity on the current time frame, or if you expect a larger move, you can target a key level on the higher time frame. It is also important to remember that you can always add extra confluence or confirmation factors to this setup to improve its win rate, depending on your trading style. For example, you might require price to fill at least 50% of the higher timeframe fair value gap, or wait for additional confirmation signals, such as an RSD formation, before entering the trade. So step back and look at what you actually learned today, because it wasn't 3 strategies, it was one engine. The higher timeframe tells you where, the lower timeframe tells you when, and a defined level puts a hard line under your risk. The only thing that changed was the fuel. An order block left by a liquidity sweep, a demand zone at the origin of the move, or a fair value gap born from a change of character. Master the engine, and you can take any high-quality point of interest the market gives you and build your 4th strategy yourself. That's the difference between copying trades and understanding them. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.